So we had spoken about leverage in our previous videos in passing, and in this video we're going to be looking at leverage in details. Now, the forex market is the most leveraged market. In fact, some people call it the leveraged market, and that's because it gives the highest amount of leverage among all other financial markets. So it gives traders the highest amount of leverage. Now, what is leverage? Okay, so leverage in forex allows traders to increase their market exposure beyond their initial investment or deposit. And this is made possible because the broker loans you their money to be able to enter a position that's big. Okay, now why is there leverage in forex? Leverage exists in forex because the movement between prices of currencies are usually very minute, very little. So in order for us to make any substantial profits, we have to take advantage of those little movements, and leverage is the only way we can take advantage of those little movements. So leverage enables us buy or sell more than we actually can afford, okay, so as to be able to make substantial profits. So with leverage, a trader can actually enter a position worth 10 times or 100 times or even 1,000 times more than their actual money can afford. And no other financial market gives that level of leverage. However, it is essential to know that when using leverage, not only profits are magnified, but also losses can get magnified. So it's important not to use leverage too much. So it's important not to use too much leverage. Some brokers can give you 1,000 times your money, can give you 10,000 times your money. I haven't seen a broker giving 10,000 times your money, but in forex, anything can happen. I'm sure there are brokers who will be willing to loan you up to 10,000 times your money, but that doesn't mean you should use that much leverage, because leverage can actually build you up and also kill you. Okay? It can build you up or kill you. So leverage of 10 to 1 means that traders can gain exposure to a notional value or trade size 10 times more than the deposit that is required to fund the trade. So when your broker gives you a leverage of 10 to 1, it means you can enter a trade 10 times your deposit. If your broker gives you 100 to 1, you can enter a trade 100 times your deposit. If your broker gives you 1,000 to 1, it means you can enter a trade 1,000 times your deposit. I don't know if you understand. If your broker gives you 1 to 1, of which doesn't exist in forex, but if let's say your broker gives you 1 to 1, it means your broker doesn't give you any leverage. It means your broker doesn't give you any leverage, and if you're entering a trade, you'll be totally responsible for funding that trade. It means if you're entering a trade with one lot size, it means you have to fund 100,000 units of the base currency. Okay? You have to fund 100,000 units of the base currency. So you have to be funding, let's say, $100,000 to enter a lot size of 1. But if your broker gives you a leverage of 1 to 2, it means you will just have to handle 50% of the deposit. That's $50,000, and your broker will then fund the remaining $50,000. That's 1 to 2. So your broker is giving you half or 50% leverage. So when a broker gives you times 10, okay, that's 10 to 1. That's 10 to 1 leverage. It means you just have to fund 10% of the amount needed to fund that trade. And when your broker gives you 100 to 1, it means times 100, it means you just have to fund 1% of the amount needed to enter that trade. And when your broker gives you 1,000 to 1, it means you just have to fund 0.1% of the amount needed to be able to actually enter the trade. Okay? Now you might think that, wow, leverage is very good. It gives me the opportunity to earn a lot of money without little deposit. It gives me the opportunity to enter big trades, make a lot of money. But like I said before, leverage is something you have to handle with caution, how to handle with care, because it can make you or break you. The same way leverage enables you make so much money, leverage can also enable you make so much loss. So let's assume your broker gives you a leverage of 10 to 1. Okay. So it means you have to just fund 10% of the amount needed to enter that trade. And you now enter the trade and it starts going in your favor. It means you're making so much money. And then all of a sudden the trade starts going against you. Now, when the trade starts going against you, all you have to do is to lose just 10% of that trade, okay, which is your initial amount. Remember, your broker is giving you the remaining. All you need to deposit is 10%. So when you lose 10% of that trade, okay, when you lose 10% of that trade, it means when you've exhausted your own money, your broker will just shut down your account and just remove their money. So it means they're not taking any risk on you. All the risk is on your head, and just because they give you leverage doesn't mean to actually use their money to fund your trade, even while you are losing beyond what you can actually afford. Okay, so that's why leverage is very dangerous. That's why using too much leverage is very dangerous. Same as the leverage for 10 to 1, 100 to 1 or 1000 to 1. So just like how leverage enables you to make a whole lot of money, same way it also magnifies your losses. Magnifies your losses if you don't use leverage correctly. That's why in forex trading we have what we call risk management. Okay, and we're going to be looking at risk management in further lessons. But just for you to know. Now that will be it for this lecture on leverage. I'm sure you can now understand the downsides and upsides of leverage and how good or bad leverage can be. Now in the next video, we'll be talking about other concepts like the take profit, the stop loss, and so on and so forth. Hope to see you in the next.